cheap to you guys?
So again, perhaps I could use a better word. I could use the word attractive, because attractive includes two things. It includes the cheapness and it includes the macroeconomics in terms of, are they doing the right things? Well,
Well, that also brings up a question of time frame. So when you talk about being bullish emerging markets, what is the time frame that you're looking at, and what is the holding period for where you're looking to get some confirmation of that bullish thesis? How long would it be that Russia doesn't sort of see multiple expansion that you would rethink that Russia thesis?
So you asked multiple questions. So let me first answer the time frame question. Basically, one of the ways that we at GMO kind of look at our asset class forecasts is we make 7-year forecasts. And the reason is basically because it's very difficult to forecast stuff in the short term of, 6 months to a year. So the idea is that the reason why we make 7-year forecasts is because what we find is that at the asset class level, when things are misvalued, that is, if the entire asset class, like emerging or the US, is trading too expensive or too cheap, etc., on average, it takes 7 years for it to cross its fair value line. So that's kind of been the historical pattern. So that's why we make 7-year forecasts. So the idea is that we believe if something is really cheap, it will mean revert to fair value over 7 years. So that's why I have no idea whether it will revert in the next 6 months, which it could, or it will revert over 7 years. So let me give you the example of the tech bubble. So going at the end of the tech bubble, if you look at January of 2000, for instance, our forecast for the S&P was minus 2.3% real for the next 7 years, i.e. that over the next 7 years, we expected that in real terms, you would lose 2.3% a year in the S&P. And our forecast for emerging was something like plus 10. What was the reality over the next 10 years? If you look at from 2000 to 2010, basically the S&P was down about 2.5% or something like that in real terms. And emerging was actually up 12.5%. So the fact is these things do play out over a long period of time. Now, if you looked at the next 6 months from that forecast, we were clearly wrong because the bubble continued for a few months before it broke. So I can't really give you a good sense for that. But coming back to Russia, I'm not so much looking for multiple expansion because a country like Russia should in fact trade at a pretty hefty discount. Because of all the risks that are legion in Russia, you should expect it to trade at 6-7 times earnings. So it's not so much the multiple expansion, it's more the earnings growth which filters through dividends and things like that. And the dividend yield, as I mentioned, is something like 6 or 7%. Now, clearly, in the short run, that will probably get cut because of oil prices falling and will have, some impact on their dividends this year, for example, and maybe next. But we certainly think that it will continue. Now, the reason why we're confident about the dividend, and this is one of the real ironies of the Russian market, is that a lot of the big companies, the oil companies, for instance, and the bank, are owned by the government. They're government-owned entities. And the government basically gets its revenue from the dividend flow of these companies. And the government has now mandated that all government-owned companies have to pay 50% of their net earnings out in the form of dividends. And that's why the dividend yields are so high. And so in an odd way, our interests as minority shareholders are aligned with the government's interests, to make sure that they receive their money.
Okay, so you mentioned banking and the oil sector. We had a viewer who asked, when we talk about EM, could we please specify a bit more about sector and company? I know that you can't talk about specific companies, so I'm just going to let the viewers know right now that
Sure.
We can talk about sectors, we can't talk about specific companies. But what particularly, why don't we start with Russia, from a sector standpoint, is attractive to you guys?
Well, basically, the problem with Russia is that it's a very thin market. When you really get down to it, between Sberbank, which is the one big bank over there, and the oil sector, they make up 70 or 80% of the index. So, and then the remainder is some retail stuff. So, interestingly enough, in Russia, all three actually are attractive. The bank, the Sberbank is attractive. We think it's extremely well run. It is extremely cheap, and has delivered very good returns for shareholders in the past. The oil companies, clearly, again, are much more of a play on oil. But even there, the way that the Russian oil companies are set up in terms of taxation and stuff like that is that their sensitivity to the oil price is less than you would have for a Western company, because the government does in fact take a big chunk of the oil revenue. And so therefore, even if the price falls a lot, it doesn't have as much impact on their earnings as it would for a Western company. And then the retail sector, we think actually, especially the retail companies, just like with Amazon, you have companies in Russia which are, are benefiting from the online, movement to online from offline. And Russia is certainly behind on that dimension. So we like that sector as well. So we like all three, actually. It's one of those countries where we kind of like all the major sectors in the country.
Now, is that emblematic of what you're seeing from other emerging markets? China is unique in its in its dynamics, but sort of with the financial sector, energy, or some sort of commodity, whatever it is, the commodity that is special to that country, and then you have a sort of growing middle class where consumer retail spending is just in a secular uptrend. Is that sort of capturing the thesis for emerging markets in general beyond Russia?
Yes, in fact, you mentioned something very important, and that is, when I was talking earlier on about the risks of emerging markets going down. Again, on that dimension, if you look back, 10 years or so, or in fact, just before the GFC, commodity companies in the form of oil, metals, things like that, were a significant part, 18-20% of the index. Today, they're only 4-5-6% of the index, versus the high-tech sectors, the technology sectors, both in Korea, Taiwan, India, places, and China especially. And in tech, I include the consumer-type tech, like the Alibabas of the world, and I include the Indian software companies, which are, more, back office kind of companies, and the Samsung Electronics, and the Taiwanese, manufacturers who make all the components for the iPhones and things like that. So, so that has become a much bigger part of it. So coming back to your question on China, one of the cool things about China is that it is such a big and diverse market that you can really treat it as different markets. If you think of the Alibabas, the JDs, the Tencents, all of those, they have benefited, in fact, from the crisis. And in many cases, a lot of these stocks are actually at all-time highs, because just like with Amazon, they've benefited from the shift from offline to online. On the other hand, the consumer sectors are still struggling. If you look at retail in China, clearly struggling, and that's going to struggle. If you look at people like who are mall operators all around the world are struggling, and they will struggle for a while to come, and maybe forever. Who knows? So you can really make those kind of distinctions in a place like China. And again, in China, they have their own banking sector, which has got its own unique characteristics. Because most of it is government-owned. And so, unlike Western banks, Chinese banks, in some sense, are they're not too big to fail. They're just simply too government-owned to fail. So they can't fail. The downside is that to what extent will they be called on to do what we call national service, by the government in a crisis? The banks clearly become a vehicle for funding stuff. And it's never clear whether that funding comes out of the government's pocket or whether it comes out of the shareholders' pocket.
So we've talked about emerging markets as being cheap, and you and I actually discussed this a little bit yesterday in our pre-interview. I'd love to get a better definition from your end of what does cheap mean for emerging markets? Because you can go and you can find, I gave the example of Iran trading at 3 or 4 times earnings, and that's still not cheap enough for some people. So what is cheap to you guys?
So again, perhaps if I could use a better word, I could use the word attractive, because attractive includes two things. It includes the cheapness, and it includes the macroeconomics in terms of are they doing the right thing. Well, let me give you, if you don't mind, I'm going to back up and give you my thesis about investing in emerging markets in the first place. That is, I spent a lot of time thinking about why is it that some countries are rich and some countries are poor? And what is it that allows a country that's poor to become rich? And what I figured out is that while there are 100 idiosyncratic reasons for each country, there is one common factor amongst the countries that become rich. And that common factor is the strength of institutions. The countries that build strong institutions that can survive long periods of bad government are the ones who basically succeed. Because at the end of the day, to become rich, you need to compound growth. And so therefore, if you have high growth for 3 or 4 years and then negative growth and then again high growth, that doesn't get you anywhere. You need to have steady compounded growth. And what allows compounding of growth is the strength of institutions, that the institutional nature holds. I mean, look at the US. No matter whatever you might think about any government, when you look at a chart of the GDP of the US, even the depression looks like a little blip. Why? It's because at the end of the day, the strength of the institutions is so strong that people have the confidence to invest and people to spend and things like that. And so therefore, the economy keeps growing at a very consistent rate for a long period of time. Whereas in emerging market, that's not true. In fact, I consider that to be the main difference between emerging and developed markets, that emerging markets don't have institutions that can survive long periods of bad government. So therefore, they're very dependent for their growth on the quality of the government that's in place at that point in time. And what that means is that you should never think of an emerging market as a long-term bet. You should never buy a country and say, I'm going to own it for 10 or 15 years. You basically need to get in and you need to get out. As I like to say, in emerging markets, you should never fall in love. You should only date, and you should date promiscuously at that. So given that kind of view of the world, the fact is that you want to get in and out of countries based on two things. Number one is cheapness. So again, those are the two dimensions I'm talking about here. So the cheapness, that is how attractive is something from a cheap point of view, and are they doing the right thing from a macroeconomic point of view? So now, to get back to your original question, what do you mean by cheapness? So the way we define cheapness is basically, we obviously have kind of sophisticated models to come up with those things. But essentially, it's a question of figuring out things like, it's a combination of multiple factors. And you can think of these factors as being valuing a country, or all the companies that are listed anyway, from 2 broad points of view. That is, how much are you paying for the cash flow, and how much are you paying for the earnings, and how much are you paying for the book? Now, clearly, over the last few years, as accounting standards have changed, and as more and more companies are, virtual companies like the Alibabas and things like that, book value doesn't mean anything. So, if you go back 50 years, in the Graham and Dodd kind of era, book value meant something because in some sense that was the tangible thing that companies actually had. That's not so much relevant anymore. It still matters a little bit for certain industries, so for example. Book matters for banks, for instance, because that's something tangible for a bank, but it means nothing for an internet company. So again, you have to kind of have valuation models that are based on what matters for those kind of sectors. And as I said, it's really cash flow and earnings, and kind of discounting those cash flows to the present and saying, and that's what you're kind of looking at. So if I had to reduce it to a simple number, I'd say, look at the PE of a country. For somebody who's, who doesn't have access to these kind of sophisticated models, I said, just look at the trailing PE ratio. That's a good indicator of cheapness.